Today, you're going to be talking to us about gamma. Take it away, Tyler.
Yeah, thanks, Matt. All right, so specifically, we're going to talk about this idea of gamma risk. I got a question on this morning and wanted to spend a few minutes talking about it. Gamma is a little bit more complicated, a little more advanced, and the reason it's relevant to the market right now is we're approaching January expiration, right? So this rears its head near expiration, becomes a bigger issue. And primarily, it's relevant also to those that sell options, right? So option sellers, let's say this is a risk. This is a risk for option sellers. If you're an option buyer, you really don't care about this. It actually helps you. It doesn't hurt you. So what is this idea of gamma risk? I'll explain like mathematically and conceptually what it is here in a second. But essentially, what it boils down to is this refers to the increasing rate at which you lose money with your short options as expiration approaches. Okay, so the rate at which you lose money speeds up if you're wrong close to expiration. So if you have two traders, trader A is short a 30-day naked put, let's say, and trader B is short a 1-day naked put. Trader B has more risk. If the stock drops, trader B will rack up losses far quicker. So you get a little bit anxious, get a little bit of anxiety as you approach expiration because you know if the stock goes in the wrong direction, that naked put trade is going to hurt really bad. You've got more quote unquote gamma risk. So conceptually, that's what we're talking about. To avoid it, right? Traders often close their short options, in this case, naked put, prior to expiration. They may say, look, I don't want to screw with gamma risk, right? He's too big of a bad guy for me to go up against. I'm always going to buy back my short options the week before expiration or 3 days before expiration or whatever, because I just don't even want to deal with the potential of racking up losses quite quickly. Well, why does that happen, right? Why do you lose money faster when you're really close to expiration? Well, we got to take a step back and refresh our memory on a few definitions here. So delta, right? This is how much the option changes in value given a $1 move, right? And so if you have a really large delta, right, you can lose quickly. And if you have a small delta, right, you lose, and it's not so much quickly. I guess we could say quickly. With a large delta, you're just impacted more, right? You have more exposure. So I'll keep it quickly. Small delta, you lose slower, right? You can lose slower. So all else equal, if I have a position that's going against me, I prefer to have a smaller delta. If I have a position that's going in the right direction, yeah, I'd like to have a high delta, but the reality is it slices both ways, right? And so where does gamma enter the equation? Well, gamma is what causes your delta to increase, okay? And if you have a high gamma position, the delta increases really fast, okay? And if you have a low gamma position, the delta increases slowly, okay? So consider, if you will, let's say the delta of your position, I'm short a put, and it's at the money. So it has a delta of 50, okay? Well, at expiration, this option, it's binary. Either the option is in the money at expiration or it's out of the money at expiration. Okay, there's no more guesswork. Maybe it'll be in the money, maybe it'll be out. Nope, at expiration, it's one or the other. It's binary. So if the option is out of the money, right, it's worthless, and it has a delta of zero. At expiration, if the option is in the money, it becomes stock, right? It gets assigned, and it becomes 100 shares of stock, and the delta of that is 100. So you have the situation, like imagine you're a second from expiration, 1 second, and you're right at the money. And if the stock moves 1 penny in one direction, you're in the money and your delta is 100. And if the stock moves 1 penny in the other direction, you're out of the money and your delta is 0. So you can literally have a position at the moment of expiration that is at the money where, you just blow it. It goes a hair one way and your delta is 100 and you're losing $100 per dollar move in the wrong direction. Or it goes in the other way and all of a sudden your delta is 0. Okay. So the speed at which your delta can go 0, 100, 0, 100. You think about what that does to your loss and how quickly you rack up losses. It's a little scary. Whereas if you're short a put and it's at the money, delta's 50, but let's say it's 1 month away, 1 month from expiration. A 1 penny move up or down wouldn't change the delta at all, right? Your delta would go from 50 to maybe 51 or 50 to 49. And so you're not all of a sudden going to go from losing a little bit to losing a ton, right? It's going to move relatively slowly. So we can both be short at the money puts. We can both have a delta of 50. You have a long-term option. You have a low gamma. Your delta is pretty stable. I, at expiration, have a very high gamma. My delta is crazy. It moves really fast. And that's not good if it's going against me because my losses rack up really quick. Okay. So basically, gamma gets higher as we approach expiration. Okay. The rate of loss speeds up with short option positions. That is gamma risk. If you want to avoid it, don't hold options close to expiration. Close them beforehand. You look at the market right now, selling off a little bit. Let's say you're short a put in IWM and your strike price is 205. You're like, oh, I'm getting really close. I got 2 days left, Thursday, Friday, then it's expiration. 2 days left, and my put's like right at the money. And there's still a decent amount of value left. That 2-day January at the money put is worth, $130. So it's like, oh, I can make $130 if I just wait 2 days and IWM chills out here. It doesn't go down much further. True. The delta's 35. If IWM drops $1, I only lose $35. But you know what happens if that put goes in the money? That delta is going to go up to 100 really fast. So my rate of loss right now is $35 per dollar drop. Here in a minute, it might be $100 per dollar drop. My rate of loss could go up 3 times in the next day or two if IWM goes down. It's a lot of risk. The rate at which you rack up losses can be very, very high if you let this get away from you. This is why it's nerve-wracking holding a short option right at expiration. On the one hand, you got a lot of reward you can make in 2 days. But on the other hand, if you're wrong, gamma is going to punch you in the face and you're going to lose a ton of money really quick. So you have this really high risk, high reward type of scenario as you approach expiration. High theta, which I haven't really talked about, but the time decay, the theta is giving you the $130 really quick. On the other hand, if you're wrong, gamma is going to eat your lunch here pretty quick. So either way, that is the dynamics that you have to weigh in your mind in terms of how do I manage this going into expiration. Whereas if you just kick this to February and you got a month left, there's really not much gamma risk at all. And you got much more room to kind of maneuver. So that's gamma risk. Again, for short options, they get close to expiration. They're riskier. You lose money quicker. So decide what you want to do. Some people bail, well before expiration. They don't want to mess with it those last few days. This is the trade-off for those that feel like selling really short-term options is a wicked smart idea because you make money really fast. Yeah, maybe. Time decay is high, but gamma risk is the flip side of the coin and the risk that you face when you do that.